Good afternoon, everyone. Welcome to the Curi RMB Capital live webinar on 6 financial concerns for physicians. We're going to begin in the next 30 seconds to a minute from now because we still have a lot of registrants who are coming in, I'm seeing. So thank you for that. For those of you just now joining, welcome to the Curi RMB Capital live webinar on the 6 financial concerns for physicians. We're going to be very shortly, just trying to give everybody an opportunity to log in. And I see the attendee count just keeps rising. So once it stabilizes for just a minute, I'll get started on our prepared remarks. Okay. All right, so let's begin. So first of all, on behalf of all of Curi RMB Capital, I'd like to welcome everyone to our webinar. Before I get started on our remarks, there's just a couple housekeeping issues and some background about Curi RMB Capital I want to provide. Curi RMB Capital has been around for quite some time, and we recently added our specialty about 6 years ago in physician focus. We have over $12 billion in assets under administration. We have over 179 employees, and we have a national footprint all the way from at our headquarters in Chicago down to where I am in Raleigh, North Carolina. And for those of you who are just as excited about March Madness as I am, please note I do have the Duke game on right now, and I will not be shouting out scores. I just want to watch in the event that Duke does indeed, have the outcome they were hoping for this afternoon. But I love Duke. Don't worry, everybody. I do love Duke. All right, so a couple other points of note is just that we recognize that you have lots of choices when it comes to partnering up with a wealth advisor and a wealth advisory firm to meet all of your specific needs. And we want to thank you for our clients, for our friends, all of you who are on the call that have supported and trusted us with your financial well-being. And we look forward to continuing to do so. Just a few housekeeping items are that today's presentation is recorded. Your video and audio is not on, so there's no need for you to find a mute button or a video off button. It's already off for you. Also, we highly encourage your participation in the Q&A section. You are able, if you put a question in the Q&A, it will be posted anonymously, so there is no need to worry that your name will be coming up if you post it in the Q&A. And then last but not least, it's my responsibility to share this disclaimer with you that past performance is no guarantee of future results, and the opinions and the analysis expressed today are subject to change at any time. This presentation is not intended to be a specific recommendation for you. It is rather intended to be educational in nature alone. So let's move on to our prepared remarks. So we're going to talk about the key issues that face physicians as they are going through their financial life cycle. So when you think about it for just a minute, physicians attain a large amount of financial success in their careers by investing heavily in their education and their training. And therefore, they start out their financial journey really with accumulating a lot of debt when they're accumulating all that knowledge and all that experience. And of course, physicians are in high demand areas of healthcare, and they make huge contributions to the field. Therefore, they have a really steep and productive life cycle of accumulating wealth over their career time. And their highest future earnings are really at the base of that big slope up. But at the same time, note that the timeline that physicians have in order to convert all that human capital that's inside of them into financial capital, into wealth that can be accumulated and passed on to the next generation, that timeline is very compressed. For a typical high income earner, they might start in their 20s or early 30s with accumulating wealth and having a high income. But for physicians, it might be a whole decade later. So physicians have a compressed timeline, and it really requires them to be very disciplined with savings and very disciplined with their investment plan. And be very, well, they're already very disciplined individuals, or they wouldn't be up to this point. And we all know that. So they have the ability to do it. A lot of times all they need is nudges here and there to be reminded of it, and also to, have someone to talk to carry through on those ideas as well. Once a physician is done with their accumulation phase of their career, they move on to wealth preservation. And usually that's when they have achieved the highest level of financial capital that they'll have during their lifetime. It's a lot of times maybe before they retire, maybe before they start, having to pay income taxes on all the 401k and IRA money that they've been accumulating. And then the focus ends up being a little bit more about protecting their wealth. And the focus tends to be a little bit more on transferring wealth to the next generation, or gifts to children, or gifts to charity. And really the focus is less about worry about not having enough in order to retire. And the focus then is making sure that they're minimizing income taxes, minimizing estate taxes, and making sure that they're passing on their values to the next generation, along with all those valuables that they've accumulated at the same time. So let's zone in on this concept of delaying the start to your career if you're a physician and you really don't get even started until you're in your, let's say, mid-30s. So you're not gonna believe this math when I show it to you. Every time I go through it, I've got someone who says, "Go back to this one. Let's talk about this." So think about for just a minute here the working years of a typical high earning professional. Maybe they get out of college in their early 20s. Maybe they go to a couple years of graduate school, and then they get started earning when they're, say, 25 years old. And maybe they plan to have the bulk of their wealth accumulation happen until they're 60 years old. So here on the left, you see the working years are age 25 until 60. If they save, as a hypothetical, $4,000 a month for those 35 years, and there's an average return on their investments of 7% per year, then at the age of 60, after 35 years of saving and investing with a discipline, they would have about $6.6 million at age 60. And that's for saving $4,000 a month. Now, why did I pick $4,000 a month? Reminder, this is not your recommendation, but when you think about it, if you do have a dual income family and you save the maximum amount to a 401k, maybe an IRA too, or a combination of 401k, IRA, spousal IRA, if you have one income family in your household, it's more achievable on a high income earner to save $4,000 a month for those 35 years. So achieving 6.6 million is reasonable if you had a 7% average annual return. And that kind of allocation, if you're wondering, it could be probably like an 80% equity to 100% equity allocation, just depending on the timeline and the cycle on that. It could be that, it might not be that. Again, nothing's guaranteed. So now let's contrast this investment plan on the left with an investment plan on the right. And all I did was say, well, what happens if instead of the working years being from starting at age 25, what if the working age started at age 35? But we're all human, so we're all going to wrap up our career, let's say at age 60, and maybe we're not wrapping up our true career, maybe we're just wrapping up the wealth accumulation part of our career. Maybe we're still working, but the real focus on taking, maybe taking call or taking longer hours or being able to do, side businesses, maybe that's what wraps up. So let's say it's only for 25 years, but you still want to achieve that same $6.6 million. And just like your other high income peers who are not physicians, well, in order to achieve that same $6.6 million, you wouldn't need to save $4,000 a month. you would need to save more than twice that, almost $9,000 a month at the same rate of return. So you would more than double your monthly savings starting at age 35 than if you just started when you were 25. That's how critical those first 10 years of saving are to your whole life cycle of building wealth. That is how critical it is. So that brings us to our very first and probably my favorite, and so I spend a little extra time on it, concept about what are the issues that physicians face when they are on their financial journey. And the very first issue they faced is that they have a delay on when they start investing. They start investing in their 30s instead of their 20s for their lifelong earning years. They have a tendency to need to invest more capital later in life instead of less capital earlier in life. They also are often tempted to work longer into their 60s, later into their 60s, than in their early 60s, like their other high income peers, for that very reason. They're having to make up that 10 years. So if you're going to invest and save over 35 years versus 25 years, and you find that you've come up short at age 60, and working longer is a lot of times what physicians tell me that they plan to do and are hoping to do. And of course, don't forget, I used an assumed rate of return of 7% for the investments, and an even amount, not an uneven amount, 7%. I didn't throw in there any kind of standard deviation or running through any of that. But just that alone, 7%, some physicians, I will hear them say, well, maybe I could get a better than 7% return, and that will help me make up the difference on the time delay. And well, you know what comes with a higher returning investment a lot of times come with riskier investments, or maybe new investments that don't have that same transparency, don't have that same liquidity, and that can be very tricky. So those are the issues that a lot of physicians face when they are facing the challenge of a delayed investment strategy. So that's number one of 6 of all of the biggest financial hurdles and challenges that physicians faced. So let's talk about physician net worth for just a second. This was a very interesting study done by Medscape family physicians during their wealth and their debt report back in 2022. I won't tell you the score on the game, but it's getting interesting. All right, so physician net worth. At the time of this study, back in 2022, looking at all physicians amongst all specialty areas, 28% of them are less than $500,000 in net worth. And the rest of them, the other 78% or so they are 72% or so, they are, greater than $500,000. So how does that compare to the general population, for example, right? Well, the general population, the mean is about $692,000. So you could say, wow, the majority of physicians have higher than the mean net worth of the general population. But keep in mind, the mean for the general population of $692,000 net worth, that's just the mean. The median is $97,000. And Federal Reserve did this publication a few years ago. Sorry, I don't have the date citation on there. But they did that study when they were not necessarily comparing physicians. So I'm taking 2 different studies and comparing physicians versus what the Federal Reserve is saying about the general population. And just noting about 43% of physicians have a higher than $1 million net worth. And how amazing is that? And it's be interesting to note that while the general population, even when you take into account billionaires, et cetera, that the vast majority of physicians have higher net worth than the mean household. And so this is true in that regardless of specialty, as I said before. So then the question is always, well, why are what are some of the concerns physicians have about their net worth? And what I found to be fascinating is that back when, again, same thing, Medscape Family Physicians, Wealth and Debt Report 2022, 28% of physicians reported experiencing some kind of a financial loss as it relates to their net worth. So if 28% of physicians are experiencing some kind of a financial loss, the question is, what is that loss? Where is it coming from? And the vast majority of physicians cited their concern about practice issues, business problems, reimbursement rate from insurance carriers and their reimbursement rate going down, expenses going up associated with operating, and then just changes in their general practice situation and makeup. Only 8% of them said that they made a bad investment or had a downturn in the stock market, which I found interesting because this report was done in 2021, right after we had a lot of bumpy years in 2018, and then of course the COVID time period too. And then other physicians are citing job losses, real estate losses, legal fees. 2% of them said that they had a financial loss due to a divorce. But I find it interesting, 72% of physicians hadn't experienced any financial loss at all they perceived. So what do we make of this? What do we make of these facts? So I would just note that a lot of physicians are worried about their net worth, and they're worried about protecting net worth because they know that because of society's view of physicians, that they are highly educated, that they have a tendency to have high income, and there's a perception that they have a high level of wealth, that they are a common target for litigation. And because they are a common target for litigation, physicians spend a long time trying to protect their wealth, not just from market loss, not just from a downturn in their practice with lower reimbursement rates, not just that, just good old-fashioned lawsuits, either an unhappy patient or, a friend or neighbor or a fellow driver on the road or a visitor to their home, anybody who's experienced some sort of a loss and they feel as if they could pin that on a physician, then they're more likely to sue, partly because personal injury attorneys also subsidize these lawsuits by offering an interest-free loan to front the expense associated with a lawsuit, and that they would be reimbursed with interest only in the event that there is success on a claim. And then also just the media, entertainment, popular culture in general have a tendency to depict, physicians as a target. And it's not like the legal system in every state is even deterring plaintiffs from pursuing it. I think you might remember the Willie Sutton quote, hey, why did you rob the bank? And the response was, well, because that's where the money is. If somebody says, well, are you unhappy with the outcome of your surgery or your procedure? Well, are you unhappy with it? Well, see if you can get made whole from those who, have a high perception of wealth. So this area of concern for physicians is probably the second most common one that I encounter over and over again. And keep in mind, I've heard the comment made to me before, hey, really, this is a very rare is it that, there's a judgment against a physician if it gets all that way. Keep in mind, a lot of the stress associated with a threat of litigation or just a letter notifying them a notice of claim in and of itself is so psychologically damaging and distracting to a physician and their own well-being that they're concerned about there being a target on them, not necessarily that the final outcome will be an actual financial loss, but the process and the years that you go through in the meantime can be very damaging to your mental well-being. So to that point, I think it's always good to just remind everybody about some of the potential asset protection strategies that we commonly talk to our physician clients about. There's three big sets, if you will, of strategies. The first set is good old-fashioned claim paying, defense representation, right? Like having good medical malpractice insurance, having a great secondary liability insurance, so that'd be your umbrella, personal liability coverage. If you serve on a board, errors and omissions coverage, cybersecurity, having plenty of insurance. In other words, an insurance company will defend you and pay a claim if there is one that is succeeded. So the other way to protect your assets is just the way that you title your accounts, just the way that you have as much assets as you can in your 401k and your rollover IRAs and your contributory IRAs, that depending on which state you're in, maxing out college 529 savings plans for your children done as a completed gift. It moves those assets out of your estate, and you can't lose something if you own it. And like 401ks and IRAs, those are often state or federally protected asset categories, so they have immunity. Depending on state laws, they would have immunity to being able to be taken by somebody who's suing you and with a successful judgment against you. Also, the cash value in your life insurance policies and sometimes annuities, it depends on what state you are in. Same thing with life insurance, depends on what state you're in. Cash or investments inside those particular types of vessels or wrappers, some people call it, those also sometimes have asset protection qualities to it. And contributory IRAs have asset protection to them up to a certain amount. So making sure even if your spouse does not engage in paid employment, that your spouse is still contributing to a spousal IRA based off of your employment record. And then some states offer tenancy by entirety, which is a real estate or bank and investment account way of titling assets between two spouses. It's not available in every state. It's not available in every state beyond just real estate, but where available, very good to take into account those types of structures. And then finally, inherited IRAs. Since I get asked this question a lot, and we have a lot more IRAs floating around being inherited by physicians, reminder that inherited IRAs do not have any asset protection qualities as it relates to litigation and being sued by, say, an unhappy patient or somebody else you were in, say, a car accident with, or slip and fell on your property and they want you to pay their hospital bills. That inherited IRA does not have any protection to it, but it does have asset protection in the event of a divorce. So if you have a spouse that's unhappy and would like to be made whole with your inheritance, that does have asset protection qualities to it. So you can see already that this gets complicated. It very much depends on your particular situation, your particular family dynamics, sometimes too, feelings, prioritization. It's very difficult to figure out what is the best strategy for you, considering all these different options. And you've probably heard of this last section, different kinds of just legal entities or just contracts between parties can also be a way to protect your assets. So having a pre or post-marital agreement with your spouse, let's say, for example, you decide to go into business with, say, your brother, and maybe you're doing a rental property together at the beach, and you're taking some marital assets out in order to do that, and you want to have an agreement with your spouse that says, hey, I'm using marital assets in order to fund this project, but I'd like us to agree that any future appreciation does not belong to you, spouse. I'm going to just split that 50-50 with my brother. That's a very specific example, but that's a good example of, just being transparent and open about what your goals are, and making sure that there's an agreement between you and your spouse about not just assets that you acquired after the marriage, but sometimes business appreciation and business assets too. And then we hear a lot about asset protection trusts. Some states are just much more amenable to these than others. There can be some problems with asset protection trusts if you overfund them and you underfund all these other protected assets in your state. So first, doing a financial plan, looking through your balance sheet, figuring out exactly how much of your future earnings, exactly how much of your current balance sheet is truly at risk as it relates to potential litigation before you go down the path of setting up an asset protection trust, which are designed to be irrevocable by their nature, as are irrevocable life insurance trusts. And I skipped over this good one here. Oh, the game has changed. Okay, I'm not distracted. All right, limited liability companies. So business assets are better owned and located inside of a business entity, like a corporation or a limited liability company, as opposed to in your personal name. I come across a lot of physicians who have accumulated real estate, maybe rental real estate, and they're keeping that rental real estate in their own personal name or their spouse's name or both their names, and not locating the rental property in a LLC of some type and having really one rental property for each LLC. So that's where I a lot of times will go ahead and see right off the bat that we need to do some asset protection work there. And it really is pretty simple. It's just changing how you're titling assets and going through the hoops of business assets inside a business entity. All right, if you have any questions up to this point, please be sure to put it in the Q&A. So at the end of my remarks, I'm able to get to it. And thank you guys for hanging with me during March Madness. Okay, so when we asked physicians through the Medscape survey back in 2022, what were some of your bad investments? Like, what were some examples for things didn't go as planned and you would consider them to be bad, like unrecoverably bad? There's a version of a downturn, which we're all very familiar with. And we've been having a lot of that here lately, here in the first quarter, 2025, with lots of market volatility. I'm not talking about that kind of a bad investment where it's just volatile. I'm just talking about like a permanent type of loss. All right. So at least 64% of the physicians who were responsive to this study said that they had made at least one mistake while investing their money. And that I thought this was great. About 15% of all physicians said that they've never made any investments at all, right? So you can't make a mistake if you've never made an investment at all. I found that interesting. And it didn't matter if it was a primary care physician or a specialist in medicine across all the different areas. They were very highly correlated between the two. So it gives us some strength and confidence in this data that the trend is pretty accurate. So one of the ways that physicians are avoiding have a bad investment is to not make an investment. And then another area where they pointed out was that 35% have said that they've never made a mistake, and 20% said that they haven't made any investments at all. So I find those to be two interesting categories. But 26% said that they invested in a stock or a company that turned out badly. So no recovery there. So that brings us to our third concept out of 6 about the common financial issues that physicians face, which is their vulnerability when it comes to solicitation of financial investments, products, opportunities, business plans, and the like. Because physicians have a high cultural perception of a high net worth. I mean, they are the scientists, they are the caregivers of our society. They have a lot of education. They tend to have great contributions, so they have high income. And so therefore, that perception culturally is that they're more likely to be approached by friends, for family members, for the next big thing, or being expected to be the provider for the families or the broader families, beach home or something like that, because they're the ones who can be that provider, which is often wonderful. And so often, many of the physicians I work with say, I can't tell you how much my family has helped me with my training and the support over time for me to become a physician. So I definitely want to give back to my family and provide for my extended family and beyond the benefits of my career. But that solicitation can sometimes sway a physician from being able to find the best investment for them and that's sustainable and that will work for them over the long term. Again, because of that solicitation factor. So in order to kind of immunize yourself a little bit, protect yourself a little bit from the financial solicitations and not knowing exactly how to answer, first, just identify and prioritize your life goals before you've been introduced to investment opportunities. So before you're shown the menu of all the different options you could do, first know what it is that you need. So go in to eyes wide open, what it is you're really looking for. Is this really right for you? It's hard to stay disciplined after you've been solicited on this great opportunity and then build a financial plan. Do it the other way first. Also, when appropriate, maximize the income tax deductibility as many savings plans as possible. So it could be that this is a great investment, but because of its nature, it's going to spin off maybe a lot of income that you don't need more income taxes to deal with. By the way, it's still a closed game. In my opinion, I don't know who else is watching out there. Be sure to put that in the Q&A too. And also, minimize your income taxes and then also prioritize other important things like shoring up your disability and your life insurance plans. Let's make sure your needs are taken care of before we move up to wants and wishes. And then always maintaining an adequate, liquid, diversified investment strategy to preserve your options, because who knows what's going to happen in life? Who knows what's to come? All right, so let's go back to our handy dandy physician life cycle and think again about what does it mean when there's this compressed timeline for saving and investing, and that you start off as a physician, sometimes with a lot of debt, but a huge amount of potential in the future for high earnings in the future, but they haven't happened yet. They haven't been realized yet. So what do we do about this risky time period here where you've not yet achieved financial wealth? You've not yet earned a full career's worth of earnings. What do we do about that? So one of the things that we need to do as a physician group is continue to remind each other to plan for the unexpected, to plan for the part of the financial plan that they don't want to happen. You don't want to have a temporary or a permanent health event that prevents you from being able to go to work. You don't want to, have a loss of life of the primary, earner of your family. You don't want to be left without an adequate amount of disability coverage. You don't want to find out that your disability insurance policy, while is there and it protects you as a physician, doesn't specifically protect the income that you're earning as your specialty in medicine. It acknowledges that your own occupation is that of a physician and that it's in medical, but it's not specifically citing your specialty within medicine, which is very important. And a lot of times for specialists, that is the very income that they're trying to protect, is their specialty income. And then also being able to understand the difference between term insurance, permanent insurance, and the different types of permanent insurance, the different types of term insurance, and know how much death benefit you need today based off of a financial plan. Again, this isn't fun to think about, but what if we built a financial plan that says, okay, what happens if you stop working in 2 years because you're disabled? What happens if you stop working in 2 years because you just don't survive until your retirement age? How much death benefit do you need today? And then how much will that death benefit decrease in need over the years to come as you accumulate assets? As you convert that human capital to financial capital, you don't need as much life insurance death benefit. And then last but not least, are you maximizing, and I'm going to say this over and over again, as much as possible, automatic savings plans into as many tax deferred accounts as possible? Why do I use the word automatic? Because we know that, like everybody else, we all do better and we're more disciplined when we have things set up as an automated program. We just automatically know we're supposed to wake up and shower before we get in the car and go to work. We don't question that. You know that that's part of the process, right? Or I hope you do. So if you know that that's the order of operation, you know you're supposed to save 15 to 20%, as much as pre-tax as possible, out of every paycheck, every bonus, every distribution from your practice, regardless of if it's pushing you over the limit on a 401k or an IRA or not. So making sure that you're maxing out as much as possible on these, what are often basically immune assets when it comes to creditors and judgments against you. Okay, we only have a few more. We have 2 more of the 6 financial concerns for physicians we're going to go over. We're going to go through these pretty quickly. So first off this is interesting. So the more wealth you have, usually the less people are knowledgeable about where their income and their expenses flow out to. But the majority of physicians, 69%, according to a review recently done, do know where their financial wealth is going out the door to. 69% of physicians know, compared to 35% of general Americans know where their wealth goes. I find that to be fascinating. And it's also not too surprising. I mean, physicians tend to be very data-driven, conscientious individuals who are more likely than not to know, even at a less formal written, but even at a mental level, generally speaking, what percentage of their wealth goes for different things. They know what things cost. They know what they're spending for the most part, which leads us to what I do notice also about physicians is they know how much they're paying in taxes. And a lot of physicians know that because most of their income is taxed as a wage and is taxed as ordinary income, that they have a higher income tax rate, that they're subject to those higher brackets than they are, let's say, for example, a real estate developer who almost all their wealth comes from the sale of, say, land or the sale of a property, and then that is treated as capital gains tax, which is a lower and a more compressed bracket of taxes, a lower tax rate overall. So the fact that physicians are primarily wage earners and are going to be earning income on ordinary income tax basis, they're going to have higher income taxes. And therefore, it's just even more important that physicians locate as much as possible their capital inside tax deferred accounts like the annuities, the life insurance, the 401ks, the cash balance plans, the IRAs. Whew, there's so many of them out there. Making sure we maximize 529 plans, health savings accounts, Roth IRAs. See, there's even more. So the more that you can locate of your hard-earned wealth into those types of accounts, the more likely you are to protect it from higher income taxes, which you have higher income taxes compared to a lot of other of your peers that are not in the medical business. Also, reminder that employee physicians have less write-offs than business owner physicians or any business owner. So they're not able to use as many tax shelters as it relates to, depreciating on a building or, depreciation or expenses associated with, expensing their education or, a vehicle that they're using in the course of their business as a physician. So minimizing or not being able to have as many write-offs is another key area that's different about physician wealth than non-physician wealth. And then also reminder that it's just even more important to defer income later during your lower income tax years after you've retired and shelter as much of your investments from income taxes as you can during your working years. Okay, so I won't tell you what the score on the game is now because we're getting down there. All right, so that said, our last and our final review is keeping pace with industry standards. So I hear this all the time, especially from the primary care physicians tell me about this, I feel like, more than this. I don't have any data to support it, but in my work with primary care physicians, I hear all the time about how healthcare is evolving quickly and research is evolving quickly, and staying up on this breadth of information is very difficult. And it takes time away from your charting. It takes time away from seeing patients, and that time away minimizes your income. So being able to keep pace with industry standards is its own challenge during all of these wealth building years. And a lot of times physicians do go back and further their specialization. You start as an orthopedic surgeon, then you want to be a pediatric orthopedic surgeon. You're going back and sometimes taking on more debt in order to add to your specialization. And then meanwhile, there's always more compliance, there's more regulatory pressures. And then meanwhile, there's a decrease on reimbursement rate from health insurance companies. And then a lot of times there's burnout, there's frustrations. There is a lot of work, and it's coming, at a physician from a lot of different vantage points: business, patients, education, family expectations, friends' expectations. This is a lot to juggle. So all that increased burnout is often unrecognized by our society. And I really would like more of a focus on financial wellness to include the mental health benefits to getting your financial house in order, having a financial plan that's written, having an accountability to help you with it, having an accountability partner to help you with it, to make sure that it gets done. All right, so these are the 6 financial concerns for physicians. I've put them in order that I hear about from physicians or that I've seen with physicians more than anything else. If you have a different order that you would put them in, I invite you to put it in the Q&A. So if you think there's if it's not delayed investment strategies and it's instead you think common target for litigation is and should be the #1 concern for physicians, I invite you to put that in the Q&A as a topic. And also vulnerability to financial solicitation. It truly seems to be a little bit more cultural too, about which physicians are more likely to be solicited or expected to help extended family members than others. But I invite you to give me feedback on this. Feedback is the best way for me to stay relevant and for us to continue to be able to serve you. Another point I wanted to make is these are 5 books that I have read that I have found to be particularly helpful in understanding the principles associated with money management, with staying on a financial plan, helping you craft a financial plan, and coming up with a spending plan that yields joy and happiness and that is fair and right for you. So The Psychology of Money by Morgan Housel is fantastic. It's 20 chapters. You could read one chapter a night. My 15-year-old son loves it. He has read it. So I think that's a really good book, and it's a great book for you to share too with friends or family. Happy Money is a very interesting book. It's been around and it's been restudied for several decades now. And it's not about how much money you spend, but the pattern and the way that you spend money is what yields happiness, which I found that book to be particularly interesting. Also a good short book, little airplane read there. This one's a little longer, Dollars and Cents by Dan Ariely. He's a Duke professor, often contributor to the Wall Street Journal on matters of behavioral finance, and very interesting book. And then Investing for a Lifetime is by one of the professors I had at the Wharton School on Investments, and he wrote this book that is very reasonable, achievable, great for a do-it-yourselfer. It's not giving you specific answers, but it's giving you specific examples. So sometimes you can kind of plug in your own numbers when you're reading it. And then never forget how awesome Thinking Fast and Slow is by Daniel Kahneman. Another great book. This is not an easy read, this last one, and it's not one you'll just pace right through. So keep that in mind. All right, so before we get into our Q&A, please note you can subscribe to our physicians page for wealth management, financial wellness tips. I have lots of blog posts there. We have videos, and we plan to post upcoming events there as well. So please feel free to subscribe there. All right, I am going to run through these questions, of which we have several that have come through. The question is, does the delayed investment strategy apply to 401ks? Absolutely. If you don't start deferring to your 401k plan until you're in your mid-30s, as opposed to in your mid-20s, absolutely. You are not on the fast track to accumulate that $6.6 million that I described that you could do if at just $4,000 a month over that 35-year timeline. So yes, the delayed investment strategy issue does apply to 401ks, IRAs, Roth IRAs, life insurance strategies, annuities, 529 plans, Roth IRAs, health savings accounts, you name it. So it doesn't matter the vessel that you invest in, and you're still going to have that delayed issue. And in my example, I did not take into account taxes. That 7% theoretically would be net after taxes. If you're wondering, maybe the tax advantages of a 401ks can give me that head start I need. It can only take you so far. So I would say no. The other question we have is, what should the balance of paying off debt to savings be? Fantastic question. I generally say it's really more about proportioning up your debt payment obligations so that you're not under saving. So it's important to do both. Money is divisible. You do not have to choose one strategy or another. This is not a binary decision-making process. You get to do both. So definitely put towards your debt the amount of debt you need to do to have, say, less than, say, 25% of your gross income going towards housing-related expenses, for example, and no more than, say, 36% of your gross income going towards all debt, not just housing, but other debt too. And then once you've hit that number, you've put that amount towards your debt, then you can start saving that 15 to 20%, ideally 20%, in your long-term and your short-term savings strategies. And we do have articles on budgeting, and we did a webinar earlier this week on budgeting. And by the way, those percentages, those are generic statements. That's not specific to you in your particular situation. For your goals, you might need to save twice as much. I just don't know what your goals are. I work with a lot of physicians who want to retire really early, super early. So you're going to have a higher need for savings there. Next question is, any website where one can check out any limitations on the asset protection strategies for each state? That's a great question. Is there a state-by-state guide on learning about the limitations on various asset protection strategies? I'm not aware of one. Wish there was one. If it was created, it would be by a law firm probably, or a law firm that specializes in asset protection. but it would need to be a national one for them to bother doing the state-by-state version. I've been to conferences where the state-by-state version is compared and contrasted, but those laws change. So, it was true in that moment, but it might not be true today. So it'd be hard to, I guess, maintain a website like that. The next question is, do you recommend setting up a living revocable trust as tenancy by entirety as a method for asset protection? There's no such thing. So there is no tenancy by entirety for revocable living trusts. Those are two different things. Revocable living trusts are great methods of asset protection if what you're trying to protect for, what you're trying to control for, is the grantor of the revocable trust declining in health or capacity, and then you want a successor trustee to step in at any time that they're already named and can do that without any, power of attorney being approved, or having a doctor confirm that you're not able, maybe having your successor trustee step in right away. So that's one of the benefits of revocable living trust. It's also called a grantor trust. So if you've ever heard it called, there's benefits to a grantor trust. That's sometimes, a lot of times, the same thing as a revocable living trust. And then the other question is, but tenancy by entirety is terrific. It means the spouses each own 100% of, say, a bank account, an investment account, or a piece of real estate. So if both spouses are named in a lawsuit, now that property is at risk if it's tenancy by entirety. If only one person is named in a lawsuit, then that whole property is immune from it being taken claim by that plaintiff if there's a judgment against the defendant. So tenants by entirety, love. Revocable living trust, it's usually like individual, not joint revocable living trust. At least in North Carolina, it's generally not recommended to have a joint revocable living trust. I'm based here in North Carolina, so I have a tendency to be a little bit more familiar there. But I hope that answers your question. If not, feel free to send me a follow-up. Let's see here. And then, do I have it? Oh, I need to show you our privacy policy. Okay, last question. This is very good. Is the $4,000 per month investments inflated over time? That's a great question. No, I intentionally chose to make that entire calculation in present value terms. Therefore, the outcome is present value and the input is present value. So instead of building inflation in, I chose to have everything in present value the whole time. So the rate of return is a present value return. The inputs, $4,000 a month or almost $9,000 a month, that's a present value amount. And the outcome is also present value amount. The only thing that's future value is your future age. Okay, that was me laughing at my own joke. All right. So I'm seeing attendees are starting to dwindle down a little bit, which means you're either watching the game, which is has a higher expected return at this point, or you have lost interest. But I just wanted to thank everybody for your participation today. It means so much to us at Curi RMB to have you participating on our webinars and sharing our webinars. Once compliance approves today's webinar, it will be emailed out to you for your review. And I continue to look forward to receiving your questions and having you engage with us either over email, or let me get that resource page back up, or over email or phone call. So please do so. And thank you again. Hope you all have a wonderful March Madness.